Hey, Muppet Trades! Want to do a video analysis update of some unusual stock options volume. Kind of a quiet Friday. I'm on the unusual stock options tab. I sorted by the lowest put to call ratio, and then I refreshed the page, and then I sorted again by the highest change in 1 month implied volatility. And I try to focus on stocks that really haven't moved too much during the day. But I'll start with the fun. No, I'll get to the fun ones. But first, I'm going to start with some dividend themes that I've seen as the micro caps have started to recover, and as the interest rates have fallen. I've kind of had this concern for myself personally. That it's a little tempting, right? Every time it's time for me, to reinvest some dividends and um, you know reallocate the portfolio with, the income that I'm getting. It's always really tempting, and of course I sometimes do, usually with, some options. So I, have enough exposure to the upside, but I'm also, not going to lose my skin, gambling on, something really speculative. Anyway, the Fed dot plot. A lot of people like to talk about, they like to make a lot of money off of, I don't have anything against entrepreneurship, but they like to be Discord experts. And, when the interest rates get jacked up, we saw a lot of people during that rate hiking cycle, they came out and they made lots of, money during Bidenflation, stagflation, telling people yield surge, yield surge. And, of course, they did get their, bear market in equities. But now, what's happened. And, I'm not really the big fundamental analyst. And, I am definitely, this isn't the big thesis of me being bullish or, anything like that. But now we're seeing interest rates start to fall. And just looking at the Fed dot plot, they've got the Fed funds rate, going from, kind of where it currently is now, 5-ish percentage down to, in the long run, their target interest rate looks like it's about 2.5%, after 2026, basically below 3%, in 2026. And of course, the Fed can be wrong. And, I'm certainly, not the biggest truster of, the Federal Reserve. But when I look at what institutions are spending their money on, yes, there's plenty of microcaps. There's lots of, sexy growth stocks, and I cover plenty of them. And, I speculate on, certainly my fair share. But I've noticed they're kind of putting their money on this yields falling theme. And that's the first thing that I'm going to focus on. And I think the biggest piece of evidence for this right here is that, we had 335. This is just for today, right? This is just one day. But, this is kind of a theme that I've seen. I've covered DVY and DIV, and I've seen VYM. Those are all dividend ETF tickers, if you thought, I was having a malfunction for a second. But a 335% unusual options volume on IGLB. So I'm going to check on the volatility in Greeks. This is long-term corporate bonds and their investment grade bonds. I believe. Yes, the iShares long-term corporate bond ETF seeks to track the investment results of an investment composed of long-term investment-grade U.S. corporate bonds and U.S. dollar-denominated bonds, including those of non-U.S. corporations and governments with remaining maturities greater than 10 years. So this is IGLB. I'm interested in some ETFs like this. IGBH, I believe that's the right ticker. I'll just make sure. Yes, IGBH is the interest rate hedged version of this. I think this has a little better long-term performance. But what I like to do, I like to blend IGBH and IGLB. I haven't used IGLB yet, but these underlying corporate investment grade, bond ETFs, they also have an ETF from BlackRock, LQDW. LQDW is an ETF from BlackRock that runs the buy right on investment grade bonds. And what I have right here from Seeking Alpha is that we've really kind of seen, a little bit of a blessing in terms of yields and bond yields. Unless the company defaults, that yield's kind of locked in more or less. That's why people make such a big deal, about 6%, 6% yields from 3-month treasury bills. As long as the U.S. government pays, its debt back, in 3 months, then, that's a 6% return, right? So that's why people freak out about yield surging. But I also think, one thing that gets left under the bus is that's when it's time, for me at least, and I think for the smart money to lock in, those yields, because, that's, kind of going to be the stabilizer of the portfolio. Everyone likes to be, all tech and small caps and looking for the next, growth sector that's going to go to Jupiter. But, I think for the most part, people tend to agree that it's hard to stay around for the long term, with an entire portfolio in options and small caps and growth stocks. Personally, in my experience, it's definitely hard to retire that way because not a lot of income. Although, side note, I'm getting off track here. These are some ETFs that I bought today. I have a mystery ETF still, there's still that. I have 2 mystery ETFs. I've bought, mystery ETF number 1 is the big one. I'm looking for some of that wifey alpha exposure. I'll just be honest. I think that's kind of where we need to be. I need to be up where some of the blue checks are. I think that this is kind of ridiculous, that, just because some of these people are paying Elon Musk rent, that they have, all types of absorbent engagement. So I still got mystery ETF 1. And, the big reason for that is because, people have liked to, trash my reputation before, even though I'm the greatest technical analyst to ever live. And I prove that constantly. There's a plethora of evidence of proof that, this is stuff that hasn't even happened before. This has never happened before in history. Wyckoff and Gann and Ralph Nelson Elliott, they definitely were not as uncannily accurate as I was. And really, only Peter Lynch and William O'Neill and a few other people, I believe in, the people in the long term. Warren Buffett and Charlie Munger, they weren't necessarily technical analysts. As far as technical analysts go, I'm up there on Mount Rushmore already. But anyway, that was a side note. I get my money from, a lot of it from these, ETFs that are selling option premium income. The one, where I was going with this is that now one company, and it's getting its competitors too. FEPI does this, FEPI, on an ETF full of, their best growth stocks with out of the money covered calls. And, JetQ's been doing this with the NASDAQ for a while. And now, QQQY is selling 0% 0 DTE covered calls on the NASDAQ. And, as far as, the benchmark of the S&P 500, I've been interested in 0 DTE S&P 500 ETF, which I'll just show right here. I've covered this for a little bit, but this has been another one that I've been adding, to the core. Really, this could be mystery ETF, but I think this is just, a common sense one for me personally. But yeah, this Yield Max ETF, MRNY, AIYY, and I would say DISO on Disney in the value side of things. But really, with Coney and NVIDIA, some of these Yield Max ETFs, even just running without, blending them with the underlying, have done pretty exceptionally well in a total return standpoint. And that's because they have synthetic covered calls. And then they do that by buying an at-the-money call, selling an at-the-money put. And then they sell, and usually, for example, that would be, say, I think Yield Max does it like 9 months out. They'll buy a call that expires in 9 months. They'll sell a put that expires in 9 months. It might not be that exact expiration, so make sure to read the prospectus and never ever to do anything in finance terms because of what someone on YouTube or X said. 100% not me, and I make that extremely clear. But I am a very active investor. This is just what I do. And this Yield Max ETF, MRNY, is a good example with AIYY, with Coney on Coinbase, with NVIDIA, and with OARK on the entire ARK ETF. Tesla has not had the best, year in the past. So Tesla, has been lagging a little bit, but still, paying, a pretty good amount of dividends, and, that can all turn around anyway. Woo! All of that was to say, YieldMax has made it possible to get large premiums from, growth stocks. So what I've done and what I did today is something I've talked about, blending an underlying growth stock like Moderna with MRNY. I did that specifically today. I'm aiming, I think, for about a 35% Moderna underlying and a 65% MRNY underlying. That's probably what I'm going to go for with AI as well. Anyway, and then DSO and ExxonMobil, those are a little less priority and they're a little lower yield, but I'm interested in those as well. And I'm trying, I can't buy every, ETF as much as I'd like to. QQQY I bought today. I also bought IWMY. I also bought JEPY. I bought iSpy. I bought HYGW, which does the buy right on high yield bonds, and SRHR on the real estate covered call ETF. And I did that in one account by clearing out RYLD. Today's the RYLD record date. I still own a pretty good amount of RYLD in a different account, but in this one other account, I'm gonna clear that out. I've held it for about 2 years, collected a good amount of dividends from it, but I'm gonna clear it out. I think there's just better options. And with the other RYLD holding that I have, what I'm going to do is I'm going to blend it with RVT, the Royce Value Trust, and IWMY, which sells 0 DTE puts. The other account that I sold it in doesn't have closed-end funds, so I can't buy RVT in that account. Anyway, this is MRNY. It's one that I've been focusing on. I bought Moderna and I bought MRNY today. What I was going to highlight, though, was this unusual options volume. It was a 308% unusual options activity and was entirely biased to the call side. I think there was one put option bought. Let's just see. Hopefully these weren't super far out of the money. Yes, there we go. 292. I don't even need. Come on now. 292 times 100, man. You know what? Just because doctors think this is impossible, I'll do. Yeah, 29,200 calls. Yep, that's the type of math. What's that one quote? Anyway, $29,000 in calls, 308% unusual options volume. Let's see if we had anything else. Nope. So, it looks like it was only about $29,300 in calls, but that's enough to trigger a 308% unusual options activity. And so let's just look at IGLB. I like analyzing these less liquid ETFs in stocks. It really makes more sense with what I'm about to say, with kind of low float stocks that are a little less liquid. But ETFs, it gives me, it also it helps me see the field of what kind of, the range of all these ETFs. I discover so many ETFs checking this, but this is what I'm kind of wanted to make the point of this video, is if this smart money person is right, this is going to have big implications in the dividend sector. And while, Intuitive Machines is landing on the moon and going up 30%, and that's great. And while they're buying Strangles on Beyond Meat before earnings, and it was very hard for me, to resist that, and I bought, my fair share of small cap too. I've seen 2 small cap stocks on the straddle screen at $1, and I bought an even number of calls on them. One of them expires in January 2026. One of them expires in December. I've talked about one of them. They report earnings on January 27th. I'm not going to talk about them in this video just because, they're a little small floats, and one of them reports earnings soon. And so I just kind of want to see, how it plays out. Nothing's secret. I mean, one of them's a crypto play, so no secrets there. But anyway, looking at IGLB, if this investor's right, 53.36. And this is kind of a theme I've seen with DVY, 53.36, is that while these, really fun growth stocks go to the moon, the part of the market that really pays lots of income, as stable as possible, you know, is kind of ripping, and it's ripping at a kind of fast rate. Cure, CURE, the healthcare leveraged ETF. I can talk about that in this video. There's a lot of examples from the healthcare sector of this happening, and so I'll get into those. But I guess I wanted to make like a Friday unusual, and I was hoping I'd see some real sexy growth names, and I think I did. But what I've also seen is that they're treating some of these dividend stocks like growth sectors, and looking at something like this, I mean, this is quite the ripping rally, and the idea that a smart money, or at least a big money person who can, trigger this, and it's kind of unusual to make a big out of the money bet on a bond ETF. That they're, the whole idea is that bonds really only lose their value over time if the company defaults within the ETF, and so it's a pretty stable source of income, and that's why the 60/40 is advocated for in the 401k world, because when March 2020 happened, the value of all the treasury bonds did act as a safe haven, and they soared, and that was what should have been 35-40% of the retirement portfolio if it's the 60/40 bond ETF, which I'm not saying is the way to go by any means. I'm just saying that's kind of the old school rule of thumb. The bonds did save, the treasury bonds at least did save the portfolio during the March 2020 crash. And so, and they also, they just stabilize the portfolio over time. And they allow the kind of higher beta, plays to run. I invest in, bonds and things like this, even though they're a little boring, because, when the VIX does, spike a little bit. And by the way, secret ETF number two doesn't really give a damn if the VIX spikes. That's been an interesting one to watch on the few days we have seen everything red. Anyway, on the few days, whenever the VIX does spike, especially going into quad witching, I tend to be very grateful that my portfolio has, bond stability, and the yield on that bond stability is very, quickly going away. And this investor, is betting that it could go away even quicker. So if I look over here at Seeking Alpha, we saw bonds, their yields for this ETF, investment grade bonds with a little bit of duration, they fell 25%, wave A. Now they've kind of taken a breather. Let's call it wave B. Maybe this is a bond yield nest, and pretty soon it's going to be a 6%, 7% yield on investment grade bonds. Maybe that is what's going to happen. But looking at, Elliott Wave, is on. It's technically voodoo. Elliott Wave is technically a conspiracy, which is why I think it's so odd whenever I talk about other occult things. They're like, no, get back to sacred geometry and, the Fibonacci ratios. I'm like, okay, like you want me to talk about, when Jupiter's in retrograde too, flower child. Anyway, looking at this, the Fed's got rates going down, and this guy, he's betting that this potentially is wave A and wave B, and that bond yields could go on another leg down, not up, 25% to wave C. And so I'm gonna map out, and what was the expiration on this? The expiration, just let's just look at the Elliott Wave count, and we can get back to the expiration. Yeah, an unusual, out of the money, fully bull bet on bond yields. And I've seen them do this with a convertible bond ETF. I think just anecdotally it was CWB. I think I saw them take a married put on that, but I think that was a married put. So, for all I know, that guy was taking the big short on convertible bonds. And if I did buy convertible bonds, I wouldn't buy CWB. I'd buy the closed-end fund from Calamos, which I'm considering doing for myself. I think it's yielding 10%. Anyway, 53.36, 44.45. Yeah, I'm looking for this to be wave 1, 2, 3, 4, 5 waves up, an A, B, C correction, wave B, and a wave C higher. So if bond yields fell 25%, and IGLB went from 50 to 59, there is this potential that, plenty of, speculative growth stocks would have gone to the moon. But what also would have happened is that for a huge portion of, what I consider for myself, a serious, percentage and a stabilizer of the bond portfolio that now has these very conveniently timed bond, buy right ETFs on it. That yield, I have a chance to lock it in. And then once that yield goes down 25%, I don't. So let's look at Keurig Dr. Pepper, unusual options volume. Just looking at it. I go to lowest put call ratio. Then I refresh. 2 hops this time. And then I refresh by the highest volume. So Keurig Dr. Pepper had 251% unusual options volume, 98% call bias. Let's see what's going on here. So this one does pay a dividend, 2.73. And the yield is 2.73. So what would happen, if Keurig Dr. Pepper, and, I've covered some of these, talked about an ETF full of a food and beverage ETF. I don't have the ticker memorized right off the bat. But Keurig Dr. Pepper, 10%, profit margins, 4.76%, return on assets, 9.76%, return on equity, interest coverage, 3.48. Each of those numbers, in my opinion, I want to see those as high as possible. As far as profitability goes, institutional shareholders, 52%. That's really only going to be relevant to me if this is a real profitable company and this is up in the 70s or 80s, and then also combined with, insider shareholders. I'm interested sometimes when insider shareholders and institutional shareholders, are over 100%. They could have some warrants in play. Anyway, everyone knows what Dr. Pepper is, right? Keurig Dr. Pepper is a beverage and coffee company in the United States and Canada. It sells its products through at-home and away-from-home channels to retailers, including supermarkets, department stores. The gist of Keurig Dr. Pepper. Come on now, Snapple. That's a Snapple fact. You guys know what Dr. Pepper is. 2.73% dividend yield with, companies like Coca-Cola. I'll mark up Keurig. I think I've got Coca-Cola already marked up, but this is KDP, just another example of, in this, another thing that I thought was a theme, over the past few years was that when 2020, happened and there was that, 3-month period where all of the quote unquote defensive stocks and the smart beta ETFs, they fell with the stock market, and they fell, a lot of them fell by, almost as much as the percentage basis as the S&P. The idea of, using these kind of defensive stocks, people thought that was outdated, and, we saw a whole new, group of growth stocks explode in response to, what happened in 2020. So, people thought for a while that, the idea of diversifying into, value and smart beta was just kind of some boomer fad. But then what I thought what was interesting is that was certainly, In the 2022 bear market, it was a much different story, diversifying into energy and value. As we can see, this ETF was making, new highs, and for this stock was making new highs, and for the stocks and ETFs in the value sector that weren't, they really did a pretty good job, holding their value. A lot of them kind of, if we look at the, retracements of this, right, most of the value sector, from the 2020 low to, the 2022, for a lot of them, they made new highs in 2022, even all throughout the year. But, even for the ones that didn't and topped with the market in the beginning of 2022, most of them, had these pretty shallow pullbacks. Some of them made it to the 50 to 61.8% retracement. None of them went all the way to, all of these, Facebook and a lot of the NASDAQ stocks, they got pretty damn close to this low. Facebook broke this low. Amazon and Netflix got a little ugly at times. And, the value stocks, they, a lot of them paid their dividends. And even just looking at, if I looked at the ETF total return calculator for a lot of these, value and dividend stocks and, the dividend sector, even though they weren't making new highs in price, they were staying sideways, and they were paying pretty large dividends that could be reinvested. And while the price wasn't making new highs, if the person, took the time to, put the underlying into a total return calculator, there was a lot of dividend stocks where the total return was running off because the interest rates were rising and the price was staying relatively stable. That was a very big theme of the BDCs and, some of the best real estate and bond ETFs. Anyway, Keurig, an ABC correction, 1, 2, 3, 4, 5 waves up, and then another ABC correction. So the big invalidation, this is way too wide. So I'm going to take the 78.6% retracement. The 78.6% retracement, 33.63. And 27.66. Actually, I think the 27.66 is the proper invalidation. Keurig's got a pretty low beta. Yeah, that's 27.66, good invalidation. And Keurig can begin a wave 3 into the upper 30s in the short term. And I even think in the long term, Keurig can go up to 41.33, 41.31, 1, 2, 3, 4, 5 waves up. Wave 1A, ABC, wave 2B. So I'm looking for Keurig to be in wave 3, not just on the short term, but if this did work out, also on the longer term cycles as well. Potentially be raising that dividend, but that's the only way the yield would get higher, I expect. IMPP, Imperial Petroleum. I bought a leap on this when it was at 1.60. I took a leap position, and it's doing pretty well. I got some wacko goofy wave crap on there, but what I'm looking for, I think this was I saw this on the unusual option. Oh baby, I'm about to make some money. Hell yeah. Oh, woo! I'm about to make some money. I bought a leap on this when it was here, and now it's run off. Oh baby, I'm deep in the money. Intrinsic value. Ooh, and it ain't done. Look at this. This is probably too conservative. 1, 2, 3, 4, 5 waves up, baby. Let's see. Unfortunately, this is probably not gonna be, someone I care about, might get drafted because of this rally, but yeah, I'm gonna make some money. Anyway, unfortunately, this is gonna be bittersweet gains, but that happens in the, it's hard to be, it's, ESG investing and stuff like that, I'll be honest, like when I made these gains, I was hearing about some really horrible stuff, in the Middle East, the genocide of the Palestinian people. And I saw unusual options volume on this after it made a low at 1.44. And I bought I got on for the ride. It looks like, I've noticed that another one in, 2.53 is a little tight. I'm just going to hold this leap position and let it ride. But I think that the MMs are, getting ready for potentially something pretty aggressive, even if it's wave 5. Doesn't really make sense that it be the length of wave 1. Real high beta frequent flyer above 2.53. Might be going up to 5 probably. Anyway, if it makes a new high above 86.08 or oh 09 on the weekly RSI, or I think this is the week. That's the daily. On the weekly RSI, I wouldn't have to do much. Only make a new high above 66.13, and that would give a lot of evidence. That's not a wave 5. It's another wave 3 in progress. Anyway, that's IMPP. I think the other thing that I've noticed, besides I've talked about Johnson and Johnson. And, some of these, I saw a Cure on this ETF. That's a leveraged healthcare name. I think that some of these healthcare stocks are starting to firm up. 1, 2, 3, 4, 5 waves up, wave 1, and ABC wave 2. This would be another example of kind of stability and high dividend yields, running away. Why kind of the sexier names in that sector, they don't have dividend yields. They're going to run away too, but I think Johnson and Johnson, might be a little more of a smart money, idea than some of these risky biotechs. But hey, what do I know? We'll see.